Hello and welcome to this latest webinar in the Your EMEA Council series. As Joanna said, this webinar is on pension plans, rules and pitfalls in the EMEA region. I'm a partner of the pensions team in London, and with me are my partners Sascha Grosjean in Germany, Markus Asshoff in France, and Brigitte Sammer in Austria. Today we will be looking at pension plans and their rules and pitfalls in the UK, Germany, France and Central and Eastern Europe, and each of us will address three broad points. The first is to give an overview of pension provision in the relevant country or countries. Second, pension issues on M&A, and then finally looking at what's new in relation to pension plans in those countries. So starting then with the United Kingdom. Broadly in the United Kingdom there are three main types of pension provision. The first is state pension provision. That is paid for by a tax on employers and employees called national insurance contributions. And currently there are two tiers of state pension provision. There is a basic state pension that is payable at retirement, and there is an earnings related additional element based on how much you earn within a particular band. The second main type is pension provision made through someone's place of work. In the UK there are two types of that pension plan. The first type is one that the employer sets up by themselves. They set aside money themselves and through deductions from pay into a separate arrangement under a trust. That trust means that the assets are kept separate from those of the company and are not available to its creditors on an insolvency of the company. The money will be looked after, invested, and the plan administered by trustees who will be appointed by the employer, albeit that 1/3 of the trustees must be nominated and selected by the members. The alternative is that the employer provides a pension plan by making arrangements through an insurance company, and that type of scheme is based on contractual arrangements entered into by the employees directly with the insurance company. Trust-based schemes in the UK can be either providing benefits on a defined benefit or defined contribution basis, whereas contract-based schemes will always provide benefits on a defined contribution basis. The third type of pension provision is personal pension provision, where an individual makes pension arrangements outside of the workplace simply by going directly to an insurance company or other regulated financial services provider and makes arrangements for that provider to make a pension plan available to them, to which they contribute the amounts that they wish to save for their retirement. In terms of what that means where there is M&A activity and what those engaged in that activity should look out for when it comes to pension plans in the UK, the answer to that depends on the type of corporate activity concerned. If the shares in a company are being acquired, then where the target company operates a defined benefit plan, the key question will be as to the funding of that plan. Is enough money being set aside on an ongoing basis to make sure that there is sufficient funds available to pay the benefits as they fall due? But it's not simply a question of checking the latest actuarial valuation to test that, because the answer to that question can be affected by other things, in particular whether the employers and trustees have complied with their obligations when it comes to not discriminating against different members of the pension scheme, for example on grounds of their sex, and also ensuring that they comply with what the rules require in terms of benefits to be provided, which often is not actually as straightforward as it sounds, as the rules of pension plans can be complicated, and it is not unusual for those to be misinterpreted. However, you also need to be careful not only to identify whether there's any defined benefit pension obligation in the target whose shares might be bought, but also whether there is any such obligation elsewhere in the group. If a sister or parent or subsidiary company has a defined benefit pension plan, then even if they are not being acquired, the target could still have some liability to contribute to that defined benefit plan. It will not happen directly, but the pensions regulator in the UK has various powers to make that happen. If, however, the pension arrangements operated by the target are defined contribution in nature, then along with checking that any contributions due have been paid, the main point at the moment is ensuring the employer has complied with its auto-enrolment obligations. In the UK over the past 5 years, a new requirement has been phased in, starting with the largest companies down to the very smallest employers, requiring the employer to automatically enrol employees into a pension scheme. The employee is free to opt out, but if not, then they remain a member of that scheme. There are minimum contributions that the employer and employee must make into such a scheme, and those requirements are being phased up, with at the moment only 2% required to be paid in, of which 1% at least must be met by the employer, but over the course of time it is being increased to 8%, with a minimum of 3% by the employer, and that will be kept under review and could still go higher in future years. If, however, the business and assets of the pension scheme are being sold rather than the shares being acquired, then the position is different. In principle, the pension plans itself and the actual obligations remain behind with the selling company. However, there is more to it. Where the selling company has an occupational pension scheme, whether that's providing benefits on a defined benefit basis or providing them on a defined contribution basis, then the law separately imposes minimum obligations on the acquiring company at the level of pension provision it makes to those employees who transfer across. However, those minimum requirements are easily satisfied and can be done so by providing a defined contribution pension scheme to the transferring employees, and that is so even if they enjoyed defined benefit provision before. In contrast, if the employer whose business is being sold operated contract-based arrangements or contributed to personal pension plans of the employees, then those obligations go across directly and they must carry on with the same level of contributions to the same type of plan after the acquisition. In terms of what's new in the UK, there are 3 main points to note. The first is, returning to where I started, there will be a change to state pension provision in the UK that's effective as from April next year. I explained that at the moment there's 2 parts to the state pension. As from April, that will change into a single-tier pension, a flat-rate pension that's available to all, so long as people have paid enough national insurance contributions. Secondly, there's been a significant change in the UK over the past year in terms of the benefits that can be provided from defined contribution plans. It is now the case that, in principle, and if the plan provider wishes to offer this, a member can take all of their retirement savings as a cash payment rather than having to buy a pension. If a cash payment is taken, then 25% is payable tax-free and the balance is taxed as income in the hands of the recipient. And finally, on a similar theme, the government is currently consulting about the taxation of pension benefits in the United Kingdom. At the moment, there is no tax on pension contributions that are made, and broadly, investments roll up tax-free under the pension plan. But there is tax when the benefits are paid. 25% can be taken tax-free, as I mentioned, with the lump sum, and the balance, if paid as pension or as a lump sum, is taxed as income in the hands of the recipient. The government, however, is consulting on whether to reverse that situation so that contributions that go in are subject to tax, but there is still no tax on investments, but there is and no tax on the benefits that get paid out. Now, it can be seen from that the effect of that is to accelerate the taxation that the government receives, which I'm sure is the prime motivation behind that in current economic circumstances. And that is the summary of pension provisions, issues and pitfalls in the UK. I will now hand over to my partner, Sascha Grosjean, to explain the position in Germany.
The German situation. We used to have a state pension scheme that was working pretty well. actually, because contributions were made on a monthly basis from wages and salaries of every German employee up to a threshold of 40%. Roundabout of the salary and wage. The problem is now that due to an aging population, the state pension scheme seems to be failing. State pensions are going to be less in the future, and they're going to be taxed in the future, something that has changed over the last decades. So that is why company pension schemes and work-based pensions become more and more important in Germany. So the government promotes what we call a three-column model for employees: the state pension, which is still in place; personal measures, which is not a real strategy, but rather a desperate reminder that everybody takes care of themselves; and the work-based pension, where the employer helps. And this is to be our topic here now. Work-based pensions, if you look at them, there are some principles that need to be remembered. Number one, they are put in place typically by individual arrangements or works council arrangements. There is practically no or very little collective bargaining in this area, actually. And total pension liabilities, in here you can see how important they are now, are an overall of approximately 550 billion euros. 52% of them relating to direct pension promises. What does that mean? Direct pension promises are, for example, situations where an employer says, employee, I'm going to pay you 500 euro per month once you reach retirement age. And the employer does not need to pay any contributions, but the funding works by putting provisions in the balance sheets of the employer. So no contribution payments in this respect. Then we have 48% of pension liabilities relating to pensions conducted through external funding vehicles, like life insurances, where you pay a certain amount of money to the funding vehicle. The important thing, apart from the balance sheet calculation, is that we don't have DC schemes, defined contribution schemes here in Germany, so there is no pay and forget. Employers always remain liable for pension payments. If the insurance or the external vehicle fails or becomes insolvent in particular, then the employer must pay the pension, actually. This is the situation so far, at least. Pensions in M&A is a hot topic, actually, because pensions are often decisive for the deal structure. The share deal, obviously, is the most simple way to structure an M&A deal, and pension plans are relatively easy to handle by transferring the pension scheme as is in most of all cases. So the company remains unchanged, and so do the pension arrangements. This is different in an asset deal scenario, where of course you have the transfer of an undertaking and the rules under European regulations that say that only the active employees transfer from the seller to the purchaser. And in this situation, it is also that only the pension arrangements and the pension liabilities of the active employees transfer to the employer, to the new employer. Having that said, this is obviously an advantage for a purchaser. However, the share deal is much easier to handle than an asset deal, and this leads to the third option, where you have a prior pension demerger scenario in order to avoid certain pension liabilities, in particular those related to retired employees. So, if you have a prior pension demerger, you handle pension in a two-step way, so to say. Number one, you demerge some or all of the pension liabilities, and then after that's been done, then you can conduct a regular share deal, actually. There is another point which often creates a little difficulties, because if you have group-owned pension vehicles and you sell a company out of a group of companies, then it might be that the purchaser does not want to take over the funding vehicle that does not belong to their own group, or they want to become a member of it. That's option number 2, but they can't stay there because they're not part of the group, the purchaser. So here you need to find ways to either become a member of the group-owned pension vehicle, or you get the funds out of the vehicle and transfer it to the purchaser, because of course they don't want to pay for the post-service liabilities. Typical pension provisions in an asset purchase agreement or or share purchase agreement involve, of course, pension warranties. In particular, a list of all pension arrangements that says there are no other pension arrangements. And number 2, a guarantee regarding the value of the pension liabilities. So it might be an option for every purchaser to check, in particular, the provision calculations in the balance sheet and get their own actuarial opinion. And if it turns out that the pension scheme is heavily underfunded, then this may in particular lead to a purchase price reduction in this situation. So it might be necessary in some cases to get involved actuarial experts. Other clauses that you might want to see in an SPA or an APA are related to the situation that I was touching on earlier, the situation where you have a group company exiting the group of companies that it used to be part of. So the target company may remain the member of the group pension fund. That can be option number 1, or the target company receives funds from the group pension vehicle or the CTA. What is a CTA? That is one thing I should also mention here. A CTA is a contractual trust arrangement, which means if you have direct pension promises, these funds are transferred to an external entity who handles the money, with the effect that the company can remove the provisions from its balance sheets, which is often important for large companies in particular. What's new in German pension law? There is a legislative initiative underway aiming at small and mid-sized businesses. There's a large number of, or a large percentage of employees covered by pension schemes if those employees work for large companies, obviously. However, you don't see that very much in little or mid-sized companies, say up to 200 employees or something. So the degree of pension arrangements is like about 30% only in these areas. So the legislator says we need to change that in order for employees to be covered in the future. And what they are trying is to introduce pensions to collective bargaining. And the legislator says if unions and employers team up in a collective bargaining agreement and introduce a joint entity in order to fund the pension liabilities, then they might also conduct the pension scheme by way of a defined contribution scheme, which is obviously very beneficial to employers, because there you have the pay and forget The legislator obviously expects unions and employers to work together finally. The government, if there is a collective bargaining agreement, can then declare the collective bargaining agreement for generally applicable to all employers and employees, whether unionized or not, and that will cover the whole landscape, actually. That's the expectation and the hope that the legislator has. This initiative must be seen as a final warning to unions and employers to finally start collective bargaining in the pensions area. And if they fail to act, it's clear that the legislator may introduce more stricter regulations. So we are in an environment, as you can see, where company pension schemes become more and more important, and politics wants employees to be covered by those pension schemes, actually. Having said that, I want to pass on the torch now to my French colleague, Markus Asshoff. Thank you for listening.
Hello, welcome from Paris. To give you an overview of the French situation. As you may know, in France, there's a strong state schemes in place. There's a three-pillar system. The first one, a mandatory basic pension scheme administered by state. A second pillar, mandatory supplementary pension scheme, is also state scheme, and there is a small market in France for a third pillar, voluntary private pension scheme that the employer can subscribe for its employees. Additionally, there is a sort of fourth pillar. Of course, on an individual basis, anyone can subscribe to private retirement savings scheme. The first and the second pillar, as I said, are mandatory schemes to which all employees must enroll, paid by contributions borne both by employer and employees, and the contributions for the basic pension scheme, first pillar, are up to 3,170 euros gross a month. For the supplementary scheme, the contributions are up to 3,360 euros a month. To give you some figures why the state scheme in France is still important, for somebody who was born in 1940, he will receive roughly 75% of his last salary when he retires. For somebody who is born in 1990, if there is no modification until his retirement, he still will receive a little bit more than 60% of his last salary. The contributions, of course, therefore are quite high to the first and second pillar mandatory pension state schemes. If somebody earns, to give an example, 5,000 euros a month, the contributions for both employer and employee are approximately 25%, and if somebody earns the double amount, 10,000 a month gross, the contributions amount to 35% approximately. The third pillar, small market, as I've said, voluntary private pension schemes subscribed by the employer. Two possibilities: defined contribution plans. The contribution level is determined from the beginning, or second, defined benefit plans with two options. The additive pension schemes, the amount received does not depend on the amount received from other pension schemes. It's in addition. The differential pension schemes, there's an amount to be added to the benefits received from other pension schemes to defined levels. For example, there's a guarantee of 70% or 75% of the last salary, and with this differential pension scheme, the employer, by the contributions, add the difference between the first and the second pillar. Mainly big companies and international groups are concerned by the voluntary pension schemes. Of this, around 30% of the companies have one or several of these voluntary private pension schemes. On the difference to Germany, the pension plans are always handled by independent third parties, especially insurance companies. There is also, of course, the possibility for some collective bargaining agreements to impose the third-party voluntary private pension scheme, so it's no longer voluntary but mandatory due to the provisions of the collective bargaining agreement. The issues, M&A issues, there are not a lot of compared to what you have heard from the UK and my colleague in Germany. The mandatory contribution to the state basis and supplementary schemes will not be altered by M&A. The voluntary private pension scheme subscribed by the employer, they will mostly be transferred with the company, and employees may benefit from the plan of the former and the new employer for a time, of course. And if there are some differences, there is a necessity to harmonize the schemes after the transfer. As you have heard, it's handled by third parties, insurance companies mainly. Therefore, there's not so a big issue on this. Of course, which has to be known, there's a necessity to assess the cost of the potential defined benefit plans set up by a company for top executive employees. This is an obligation. What's new in France? In summer, a new law specifically regarding the defined benefit plans for corporate officers of listed companies. There's a tighter control and the liabilities have to be more secured. And also a little evolution in France, of course, due to an employer's trade union agreement of October 30, 2015. The aim of the agreement is to determine the future of the complementary retirement plan. The agreement creates a specific bonus system encouraging employees to delay the date of retirement in order, of course, to keep the percentage an employee will receive once he retires high as it is still today in France. Thank you very much. I will hand over now to my colleague Brigitte Sammer in Vienna.
Thank you, Markus. I will give an overview on Central and Eastern Europe, in particular focusing on Austria. In Austria, there exists the three-pillar system of obligatory state pension, voluntary work-based pension, and private individual pensions. In other CEE countries, this varies. In general, it can be said that work-based pensions are not very common in CEE countries. The obligatory state pension provision in Austria is mainly funded by national insurance contributions of employers and partially of employees from their gross salary. Pension payments after retirement, in particular in Austria, depend on the contributions made during the working life, namely years and amounts of the contributions paid in. This first pillar is still a main provision, pension provision in Austria, but also in other CEE countries. The second pillar, the work-based pension schemes in Austria, comprise the following four alternatives. There is the possibility of a direct commitment of the employer to pay a pension. This may be a commitment of defined contribution, namely performance-oriented, or a commitment of defined benefit, namely contribution-oriented. For this type of pension, this direct commitment, security papers of 50% are required. Further, There's the option of a commitment to a pension fund. It may also be performance or contributions oriented. In particular, this option also exists in some CE countries. In this case, the pension fund will pay the pension to the employees. There may also be a corporate group insurance, which is a collective life insurance for the operation. And then there may be the purchase of a life insurance by the employer for individual employees, however, always observing the principle of non-discrimination. Then we have the personal pension provisions, which are not subject to specific statutory rules and may be chosen by the employees individually. Let's have a look on pension issues on M&A as regards shares acquisitions. If the defined benefit liability is in the target, then the rights and obligations generally remain unchanged. However, in some CE countries, but usually not in Austria, the employer may terminate this liability. If the defined benefit liability is in connected or associated parties, then, in principle, the commitment is entered into by the company through private commitment, the works council agreement, or it exists through a collective bargaining agreement. So the liability nevertheless lies with the company, in this case, whose shares were acquired. So consequently, the liability remains unchanged. In some CE countries, the employer may terminate it. As regards business acquisition, in some CE countries, the pension rights would transfer with the employees, in others not. In this case, the employees in some CE countries would be entitled to the payment of the already vested pension. If the pension is based on a works council agreement, which transfers, the acquirer would principally be obliged to provide the same pension provision. At this point, I would like to add that if the pension provision is provided by a collective bargaining agreement, its further applicability depends on the destiny of this collective bargaining agreement. This could vary according to the circumstances. However, only in very restricted areas such collective bargaining agreements exist in Austria. As far as individual pension agreements in Austria are concerned, they transfer if the purchaser is a universal successor of the seller. If he's not, then the purchaser may refuse the pension obligation. In such a case, the employee may object to the transfer of his employment, and consequently, he would remain employed with the seller. In the Ukraine, the pension payment would be immediately due as employment would be terminated. What's new in Central and Eastern Europe? As regards the state pension provisions in Austria, the requirements for early retirement were tightened. In the Czech Republic, the second pillar, which permitted an investment of 2 to 3% from the gross salary into a fund of the employee's choice, was now again deleted due to the lack of attractiveness. So it was not really accepted, and therefore the change was made. In Poland, the retirement age of 67 for state pensions, which was implemented a few years ago, was now reduced again to the former requirement of 60 for women and 65 for men, due to a political change. So that was an overview on the situation in Central and Eastern Europe. And now I would like to hand over to my colleague Mark Smith again.
Thank you, Brigitte, and thank you everybody for tuning into our webinar today. We have not had any questions emailed to us during the course of the webinar, but I appreciate that sometimes thoughts, questions can occur later on. The contact details for all of us are available on the Taylor Wessing website, www.taylorwessing.com. And if you have any questions at any point, or we can otherwise assist, then please do feel free to contact us. Thank you very much for joining us today.